for navigating big debt crises. 25. A good example of how these forces are relevant is highlighted by the differences between the debt/banking crises of the 1980s and 2008. In the 1980s, there was not as much mark-to-market accounting, because the crisis involved loans that weren't traded every day in public markets, so the banks were not as insolvent as they were in 2008. With more mark-to-market accounting in 2008, the banks required capital injections and/or guarantees to improve their balance sheets. Both crises were successfully managed, though the ways they were managed had to be different. Going into the depression phase of the cycle, by which I mean the severe contraction phase, some protections learned from past depressions, example bank deposit insurance, the ability to provide lender of last resort financial supports and guarantees and to inject capital into systemically important institutions or nationalize them, are typically in place and are helpful, but they are rarely adequate, because the exact nature of the debt crisis hasn't been well thought through. Typically, quite a lot of lending has taken place in the relatively unregulated shadow banking system, or in new instruments that have unanticipated risks and inadequate regulations. What happens in response to these new realities depends on the capabilities of the policy makers in the decision roles and the freedom of the system to allow them to do what is best. Some people mistakenly think that depressions are psychological, that investors move their money from riskier investments to safer ones, example from stocks and high-yield lending to government bonds and cash, because they're scared, and that the economy will be restored if they can only be coaxed into moving their money back into riskier investments. This is wrong for two reasons. First, contrary to popular belief, the deleveraging dynamic is not primarily psychological. It is mostly driven by the supply and demand of, and the relationships between, credit, money, and goods and services, though psychology of course also does have an effect, especially in regard to the various players' liquidity positions. Still, if everyone went to sleep and woke up with no memory of what had happened, we would be in the same position, because debtors' obligations to deliver money would be too large relative to the money they are taking in. The government would still be faced with the same choices that would have the same consequences, and so on. Related to this, if the central bank produces more money to alleviate the shortage, it will cheapen the value of money, making a reality of creditors' worries about being paid back an amount of money that is worth less than what they loaned. While some people think that the amount of money in existence remains the same and simply moves from riskier assets to less risky ones, that's not true. Most of what people think is money is really credit, and credit does appear out of thin air during good times and then disappear at bad times. For example, when you buy something in a store on a credit card, you essentially do so by saying, "I promise to pay." Together you and the store owner create a credit asset and a credit liability. So where do you take the money from? Nowhere. You created credit. It goes away in the same way. Suppose the store owner rightly believes that you and others won't pay the credit card company and that the credit card company won't pay him. Then he correctly believes that the credit asset he has isn't really there. It didn't go somewhere else, it's simply gone. As this implies, a big part of the deleveraging process is people discovering that much of what they thought of as their wealth was merely people's promises to give them money. Now that those promises aren't being kept, that wealth no longer exists. When investors try to convert their investments into money in order to raise cash, they test their ability to get paid, and in cases where it fails, panic-induced runs and sell-offs of securities occur. Naturally, those who experience runs, especially banks, though this is true of most entities that rely on short-term funding, have problems raising money and credit to meet their needs, so debt defaults cascade. Debt defaults and restructurings hit people, especially leveraged lenders, example banks, and fear cascades through the system. These fears feed on themselves and lead to a scramble for cash that results in a shortage, i.e., a liquidity crisis. The dynamic works like this. Initially, the money coming into debtors via incomes and borrowing is not enough to meet the debtor's obligations. Assets need to be sold and spending needs to be cut in order to raise cash. This leads asset values to fall, which reduces the value of collateral, and in turn reduces incomes. Since borrowers' creditworthiness is judged by both A, the values of their assets/collaterals in relation to their debts, i.e., their net worth, and B, the sizes of their incomes relative to the sizes of their debt service payments, and since both their net worth and their income fall faster than their debts, borrowers become less creditworthy and lenders more reluctant to lend. This goes on in a self-reinforcing manner. Part 1. The Archetypal Big Debt Cycle 26. The depression phase is dominated by the deflationary forces of debt reduction, i.e., defaults and restructurings, and austerity occurring without material efforts to reduce debt burdens by printing money. Because one person's debts are another's assets, the effect of aggressively cutting the value of those assets can be to greatly reduce the demand for goods, services, and investment assets. For a write-down to be effective, it must be large enough to allow the debtor to service the restructured loan. If the write-down is 30%, then the creditor's assets are reduced by that much. If that sounds like a lot, it's actually much more. Since most lenders are leveraged, example they borrow to buy assets, the impact of a 30% write-down on their net worth can be much greater. For example, the creditor who is leveraged 2:1 would experience a 60% decline in his net worth, i.e., their assets are twice their net worth, so the decline in asset value has twice the impact. 0.7 Since banks are typically leveraged about 12:1 or 15:1, that picture is obviously devastating for them and for the economy as a whole. Even as debts are written down, debt burdens rise as spending and incomes fall. Debt levels also rise relative to net worth, as shown in the chart below. As debt-to-income and debt-to-net worth ratios go up and the availability of credit goes down, naturally the credit contraction becomes self-reinforcing on the downside. 1929 household debt as a percent of net worth 5%, 10%, 15%, 20%, 25%, 1920, 1930, 1940, 1950, 1960, 1970, 1980, 1990, 2000, 2010. The capitalist's investor class experiences a tremendous loss of real wealth during depressions because the value of their investment portfolios collapses. Declines in equity prices are typically around 50%, their earned incomes fall, and they typically face higher tax rates. As a result, they become extremely defensive. Quite often, they are motivated to move their money out of the country, which contributes to currency weakness, dodge taxes, and seek safety in liquid, non-credit dependent investments, example low-risk government bonds, gold, or cash. Of course, the real economy as well as the financial economy suffers. With monetary policy constrained, the uncontrolled credit contraction produces an economic and social catastrophe. Workers suffer as incomes collapse and job losses are severe. Hard-working people who once were able to provide for their families lose the opportunity to have meaningful work and suddenly become either destitute or dependent. Homes are lost because owners can no longer afford to pay their mortgages, retirement accounts are wiped out, and savings for college are lost. These conditions can persist for many years if policymakers don't offset the depression's deflationary forces with sufficient monetary stimulation of a new form. Managing depressions, as mentioned earlier, the policies that reduce debt burdens fall under four broad categories. 1. Austerity. 2. Debt defaults/restructurings. 3. Debt monetization/money printing. And 4. Wealth transfers, i.e., from the haves to the seven. Here's how the math works. If you're levered 2:1, the value of your assets is twice your net worth. To put numbers on it, say you own $100 of assets and your debts are $50. In that case, your net worth is $50. If the value of your assets falls by 30%, you're left with $70 of assets and $50 of debt. Your net worth is now $20. That's 60% less than the net worth of $50 you started with, even though your assets only fell 30%. Being levered 2:1 doubles the impact of the asset price decline on your net worth. Similarly, 3:1 leverage would triple it, and so on. Principles for navigating big debt crises. 27 have-nots. By using these kinds of levers well, policymakers can mitigate the worst effects of a depression and manage both the failed lenders and borrowers and the economic conditions. But it's important to recognize that each of these levers has different impacts on the economy and creditworthiness. The key is to get the mix right, so that deflationary and depressive forces are balanced with inflationary and stimulative ones. Policymakers typically get the mix between austerity, money printing, and redistribution wrong initially. Taxpayers are understandably angry at the debtors and at the financial institutions whose excesses caused the debt crisis, and don't want the government, i.e., their taxes, to bail them out. And policymakers justifiably believe that debt excesses will happen again if lenders and borrowers don't suffer the downsides of their actions, which is called the moral hazard problem. For all these reasons, policymakers are usually reluctant and slow to provide government supports, and the debt contraction and the agony it produces increase quickly. But the longer they wait to apply stimulative remedies to the mix, the uglier the deleveraging becomes. 8 Eventually they choose to provide a lot of guarantees, print a lot of money, and monetize a lot of debt, which lifts the economy into a reflationary deleveraging. If they do these things and get the mix right quickly, the depression is much more likely to be relatively short-lived, like the short period of depression following the U.S. crisis in 2008. If they don't, the depression is usually prolonged, like the Great Depression in the 1930s, or Japan's lost decade following its bubble in the late 1980s. To reiterate, the two biggest impediments to managing a debt crisis are, A. the failure to know how to handle it well, and B. politics or statutory limitations on the powers of policymakers to take the necessary actions. In other words, ignorance and a lack of authority are bigger problems than debts themselves. While being a successful investment manager is hard, it's not nearly as hard as being a successful economic policy maker. We investors only have to understand how the economic machine works and anticipate what will happen next. Policy makers have to do that, plus make everything turn out well, i.e., they have to know what should be done while navigating through all the political impediments that make it so hard to get it done. To do that requires a lot of smarts, a willingness to fight, and political savvy, i.e., skills, and heroism, and sometimes even with all those things, the constraints under which they work still prevent them from being successful. Below I'll walk through each of the 4 levers and how they are typically used in the depression phase. Austerity. In the depression phase, policy makers typically try austerity because that's the obvious thing to do. It's natural to want to let those who got themselves and others in trouble to bear the costs. The problem is that even deep austerity doesn't bring debt and income back into balance. When spending is cut, incomes are also cut, so it takes an awful lot of painful spending cuts to make significant reductions in the debt/income ratios. As the economy contracts, government revenues typically fall. At the same time, demands on the government increase. As a result, deficits typically increase. Seeking to be fiscally responsible, at this point governments tend to raise taxes. Both moves are big mistakes. Printing money to stop the bleeding and stimulate the economy quite often runs on lending institutions occur, especially those that aren't protected by government guarantees. That puts the central bank and the central government in the position of having to decide which depositors/lenders should be protected from losses and which should be allowed to sustain them, and which institutions are systemically important and should be saved, and how to do these things in a way that maximizes the safety of the aid. I don't mean to convey that debt reductions and austerity don't play beneficial roles in the deleveraging process, because they do, but unless they are balanced with reflationary money printing, monetization, and guarantees, they cause a huge amount of pain while not doing enough to restore the economy. Part 1. The archetypal big debt cycle 28 financial/economic system while minimizing costs to the government/taxpayers. At such times all sorts of guarantees are offered to systemically critical financial institutions, and quite often some of these institutions are nationalized. Typically there are a lot of laws and politics that affect how quickly and how well this is done. Some of the money that is needed comes from the government, i.e., it is appropriated through the budget process, and some from the central banks, by printing. Governments inevitably do both, though in varying degrees. In addition to providing money to some essential banks, governments also typically provide money to some non-bank entities they consider essential. Next, they must ease the credit crunch and stimulate the overall economy. Since the government is likely having trouble raising funds through taxation and borrowing, central banks are forced to choose between printing still more money to buy their government's debts or allowing their governments and their private sector to compete for the limited supply of money, which will only tighten money further. Inevitably, they choose to print. Typically, though not necessarily, these moves come in progressively larger doses as more modest initial attempts fail to rectify the imbalance and reverse the deleveraging process. However, those early efforts do typically cause temporary periods of relief that are manifest in bear market rallies in financial assets and increased economic activity. During the Great Depression there were 6 big rallies in the stock market, of between 16% and 48%, in a bear market that declined a total of 89%. All of those rallies were triggered by government actions that were intended to reduce the fundamental imbalance. When they are managed well, those shifts in policies to print money, buy assets, and provide guarantees are what moves the debt cycle from its depression/ugly deleveraging phase to its expansion/beautiful deleveraging phase. The chart below shows how this money printing happened in the US in the 1930s and again after 2008. 1910, 1920, 1930, 1940, 1950, 1960, 1970, 1980, 1990, 2000, 2010, 2020 USA 3-year money growth, percent GDPN, minus 0.5%, 0%, 0.5%, 1%, 1.5%, 2%, 2.5%, 3%, 3.5%, 4%. Monetization begins while highly stimulative monetary policy is a critical part of a deleveraging, it is typically not sufficient. When risks emerge that systemically important institutions will fail, policymakers must take steps to keep these entities running. They must act immediately to curtail panic and guarantee liabilities. Governments can increase guarantees on deposits and debt issuance. Central banks can provide systemically important institutions, i.e., institutions whose failures would threaten the ongoing operating of the financial system and/or that of the economy, with injections of money. Occasionally, governments can force liquidity to remain in the banking system by imposing deposit freezes, which is generally undesirable because it intensifies the panic, but is sometimes necessary because there is no other way of providing that money/liquidity. Provide liquidity. When private credit is contracting and liquidity is tight, the central bank can ensure that sufficient liquidity is provided to the financial system by lending against a widening range of collateral or to an increasingly wide range of financial institutions that are not normally considered part of their lending practices. Principles for Navigating Big Debt Crises 29 support the solvency of systemically important institutions. The first step is usually to incentivize the private sector to address the problem, often by supporting mergers between failed banks and healthy banks and by regulatory pushes to issue more capital to the private sector. In addition, accounting adjustments can be made to reduce the immediate need for capital to maintain solvency, buying more time for the institutions to earn their way out of their problems. Recapitalize/nationalize/cover losses of systemically important financial institutions. When the above approaches are insufficient to deal with the solvency problems of systemically important financial institutions, governments must step in to recapitalize failed banks. Moving to stabilize lenders and maintain the credit supply is critical to preventing a crisis from getting worse. Certain institutions are part of the plumbing of the system. One would hate to lose them even if they're not making money at the moment. It would be like losing a shipping port in a depression because the port goes broke. You want the port to continue to operate and ships to come in, so you have to protect it one way or another, whether through a nationalization, loans, or capital injections. Debt defaults/restructurings. Ultimately, the process of cleansing existing bad debts is critical for the future flow of money and credit and for a return to prosperity. The challenge for policymakers is to allow that process to work itself out in an orderly way that ensures economic and social stability. The best managed cases are those in which policymakers a. swiftly recognize the magnitude of the credit problems, b. don't save every institution that is expendable, balancing the benefits of allowing broke institutions to fail and be restructured with the risks that such failures can have detrimental effects on other creditworthy lenders and borrowers, c. create or restore robust credit pipes that allow for future borrowing by creditworthy borrowers, and d. ensure acceptable growth and inflation conditions while the bad debts are being worked out. Longer term, the most important decision that policymakers have to make is whether they will change the system to fix the root causes of the debt problems or simply restructure the debt so that the pain is distributed over the population and over time so that the debt does not impose an intolerable burden. These things rarely happen right away. Policymakers typically fail to recognize the magnitude of the problem initially, instead enacting a number of one-off policies that are insufficient to move the needle. It is only after what is usually a couple of years and a lot of unnecessary economic pain that they finally act decisively. How quickly and aggressively policymakers respond is among the most important factors in determining the severity and length of the depression. And the question of exactly how these costs are divided between the government, which means the society as a whole, and the bondholders, of varying seniorities, equity holders, depositors, etc., is an important one. Typically, non-systemically important institutions are forced to absorb their losses, and if they fail, are allowed to go bankrupt. The resolution of these institutions can take several different forms. In many cases, about 80% of the cases we studied, they are merged with healthy institutions. In some other cases, the assets are liquidated or transferred to an asset management company, AMC, set up by the government to be sold piecemeal. In some cases, policymakers recognize that ensuring the viability of the whole banking system is critical, and liquidity and solvency measures are taken at the banking system level. In recent years, it has become common for guarantees of bank liabilities to be issued in countries in the developed world. In rare cases, government-financed bank recapitalization is done across all banks, rather than focus solely on systemically important institutions. There are relatively clear lines for which creditors receive protections. Small depositors are given preference and experience minimal or no losses, in nearly every case. Often this is explicitly defined as part of a deposit insurance scheme. Coverage is usually expanded during the crisis period in order to ensure liquidity for the banks. Even in cases where there isn't an explicit deposit insurance scheme, depositors are often prioritized. In around 30% of cases studied, depositors did take losses, though they were often on foreign exchange deposits through conversion at below-market exchange rates. In most cases, when institutions fail, equity, subordinated debt, and large depositors absorb losses regardless of whether the institution was systemically important or not. Protection of senior end. Part 1. The archetypal big debt cycle. 30 subordinated debt holders, and equity recapitalizations that are simply dilutive to existing equity holders, are seen mostly in the developed world. Sometimes policymakers prioritize domestic creditors over foreign creditors, especially when their loans are to private sector players and are lower down in the capital structure. This is especially true as deposit insurance programs run low on funds. But at the same time, governments often end up prioritizing the payment of loans from multinational institutions like the IMF and BIS, as it's important to maintain availability of support from these public entities, who effectively act as lenders of last resort to countries under stress. Typically, the process of dealing with the failed lenders is accompanied by a spate of regulatory reforms. Sometimes these changes are modest and sometimes they are very large, sometimes they are for the better and sometimes they are for the worse. They range from changes in how banks operate, example putting in deposit guarantees in the 1930s or Dodd-Frank and the Volcker Rule in 2010 in the US, to labor market reforms, from requiring banks to improve credit standards to opening the banking system to competition, including foreign entrants, to raising capital requirements and removing protections to lenders. Politics plays a big role in determining what reforms are made. In some cases, such reforms end up distorting private sector market-based incentives on the flow of lending, which can limit the flow of credit to creditworthy borrowers and/or increase the risks of future credit problems emerging. In other cases, they improve the flow of credit, protect households, and reduce the risk of debt problems in the future. There are two main ways in which failed lenders' assets or existing lenders' bad assets are managed. They are either a. transferred to a separate entity, an AMC, to manage the restructuring and asset disposal, about 40% of the cases studied, or B, they remain on the balance sheet of the original lending institution to manage, about 60% of cases. And there are several main levers for disposing of the non-performing loans. A. Restructuring, example working out the loans through extended terms. B. Debt for equity swaps and asset seizures. C. Direct sales of the loans or assets to third parties. And D. Securitizations. The use of an AMC generally accelerates the management of the debt problem because it frees up existing banks to return to lending and helps consolidate the bad debts to a centralized entity that can manage sales and restructurings. Selling assets to AMCs also often serves as a mechanism to engage in transfers to banks by pricing them at above market prices. AMCs are typically publicly owned entities that are mandated to sell the assets within some targeted time frame, example 10 years, while minimizing costs to the taxpayer and disruptions of asset markets. They do this by seeking to quickly sell off the performing assets of failed institutions and working over time to manage and sell off non-performing assets. In some cases, AMCs have explicit goals to restructure the non-performing debts to reduce debt burdens. They are generally financed by some form of direct or pseudo-government debt issuance, and they cannot work well when legal, political, or funding constraints limit their ability to recognize bad debts and restructure them. Allowing the original lender to manage its bad debts often occurs when the original lender is state-sponsored, which makes it closer to a public AMC. In other cases, losses may be allowed to sit on the lender's balance sheet if they are not too large, if the technical expertise to create a centralized AMC doesn't exist, or if effective resolution mechanisms already exist. Much as with lenders, there is usually a relatively clear distinction between how systemically or strategically important borrowers are handled and how those that aren't are. For systemically important borrowers or strategically important ones, policymakers generally take steps to ensure that the businesses remain intact as entities. In general, this occurs through a restructuring of the debts to make the ongoing debt service manageable. This can occur through debt for equity swaps, through reducing the existing debts, lowering interest rates, or terming out the borrowing. Occasionally, policymakers also introduce new lending programs to these borrowers to ensure their ongoing liquidity. This process is often explicitly one of the goals of AMCs set up to manage bad debts. Principles for navigating big debt crises. 31 Non-systemically important borrowers are usually left to restructure their loans with private lenders or are allowed to go bankrupt and are liquidated. Central governments often take steps to help reduce the debt burdens on the household sector. AMCs may also take steps to restructure debt burdens rather than foreclosing on the loans as part of their goal of maximizing recovery values. The table below shows how frequently the previously described policy moves were deployed in our study of the 48 historical cases detailed in Part 3. Frequency of levers used to manage debt problems, percent of cases, Liquidity support emergency lending / liquidity 88% bank liability guarantee 58% bank holiday / deposit freeze 21% address insolvent lenders bank restructuring / mergers 81% recapitalization 73% nationalization 60% losses imposed on depositors 29% dispose of bad debts through asset purchases and transfers 44% through centralized asset management cost 38% sovereign default / restructuring 35% IMF program 52% redistributing wealth gaps increased during bubbles and they become particularly galling for the less privileged during hard times. As a general rule, if rich people share a budget with poor people and there is an economic downturn, there will be economic and political conflict. It is during such times that populism on both the left and the right tends to emerge. How well the people and the political system handle this is key to how well the economy and the society weather the period. As shown below, both inequality and populism are on the rise in the US today, much as they were in the 1930s. In both cases, the net worth of the top 0.1% of the population equaled approximately that of the bottom 90% combined. U.S. net wealth shares bottom 90%, top 0.1%, 0%, 5%, 10%, 15%, 20%, 25%, 30%, 35%, 40%, 1900, 1910, 1920, 1930, 1940, 1950, 1960, 1970, 1980, 1990, 2000, 2010, 2020 era of populists, emergence of populism. In some cases, raising taxes on the rich becomes politically attractive because the rich made a lot of money in the boom, especially those working in the financial sector, and are perceived to have caused the problems because of their greed. The central bank's purchases of financial assets also disproportionately benefit the rich, because the rich own many more such assets. Big political shifts to the left typically hasten redistributive efforts. This typically drives the rich to try to move their money in ways and to places that provide protection, which itself has effects on asset and currency markets. It can also cause an economic hollowing out of those areas because the big income earners, who are also the big income taxpayers, leave, reducing overall tax revenues and leading these areas to suffer sharp declines in property values and reductions in services. Part 1. The archetypal big debt cycle 32. Typically, increased taxation takes the form of greater income, property, and consumption taxes because these forms of taxation are the most effective at raising revenues. Wealth and inheritance taxes are sometimes also increased 9, though these typically raise very little money because so much wealth is illiquid that it is practically difficult to collect on, and forcing the taxpayer to sell liquid assets to make their tax payments undermines capital formation. Regardless, transfers rarely occur in amounts that contribute meaningfully to the deleveraging, unless there are revolutions and huge amounts of property are nationalized. 5. The beautiful deleveraging. A beautiful deleveraging happens when the four levers are moved in a balanced way so as to reduce intolerable shocks and produce positive growth with falling debt burdens and acceptable inflation. More specifically, deleveragings become beautiful when there is enough stimulation, i.e., through printing of money/debt monetization and currency devaluation, to offset the deflationary deleveraging forces, austerity/defaults, and bring the nominal growth rate above the nominal interest rate but not so much stimulation that inflation is accelerated, the currency is devaluated, and a new debt bubble arises. The best way of negating the deflationary depression is for the central bank to provide adequate liquidity and credit support, and, depending on different key entities' needs for capital, for the central government to provide that too. Recall that spending comes in the form of either money or credit. When increased spending cannot be financed with increased debt because there is too much debt relative to the amount of money there is to service the debt, increased spending and debt service relief must come from increased money. This means that the central bank has to increase the amount of money in the system. The central bank can do this by lending against a wider range of collateral, both of lower quality and longer maturity, and also by buying, monetizing, lower quality and/or longer term debt. This produces relief and, if it's done in the right amounts, allows a deleveraging to occur with positive growth. The right amounts are those that a. neutralize what would otherwise be a deflationary credit market collapse and b. get the nominal growth rate marginally above the nominal interest rate to tolerably spread out the deleveraging process. So, what do I mean by that? Basically, income needs to grow faster than debt. For example, let's assume that a country going through a deleveraging has a debt-to-income ratio of 100%. That means that the amount of debt it has is the same as the amount of income the entire country makes in a year. Now think about the interest rate on that debt. Let's say it's 2%. If debt is 100 and the interest rate is 2%, then if no debt is repaid it will be 102 after 1 year. If income is 100 and it grows at 1%, then income will be 101, so the debt burden will increase from 100/100 to 102/101. So for the burdens from existing debt not to increase, nominal income growth must be higher than nominal interest rates, and the higher the better, provided it is not so high that it produces unacceptable inflation and/or unacceptable currency declines. People ask if printing money will raise inflation. It won't if it offsets falling credit and the deflationary forces are balanced with this reflationary force. That's not a theory, it's been repeatedly proven out in history. Remember, spending is what matters. $1 of spending paid for with money has the same effect on prices as $1 of spending paid for with credit. By printing money, the central bank can make up for the disappearance of credit with an increase in the amount of money. This printing takes the form of central bank purchases of government securities and non-government assets such as corporate securities, equities, and other assets, which is reflected in money growing at an extremely fast rate at the same time as credit and real economic activity are contracting. Traditional economists see that as the velocity of money declining, but it's nothing of the sort. What is happening at such times is that credit destruction is being offset by money creation. If the balance between replacing credit and actively stimulating the economy is right, this isn't inflationary. But there is such a thing as abusive use of stimulants. Because stimulants work so well relative to the alternatives, there is a real risk that they can be abused, causing an ugly inflationary deleveraging, like the Weimar Nine. The extent to which wealth taxes can be applied varies by country. For example, they have been judged to be unconstitutional in the US but have been allowed in other countries. Principles for navigating big debt crises. 33. Hyperinflation of the 1920s, or those in Argentina and Brazil in the 1980s. The key is to avoid printing too much money. If policymakers achieve the right balance, a deleveraging isn't so dramatic. Getting this balance right is much more difficult in countries that have a large percentage of debt denominated in foreign currency and owned by foreign investors, as in Weimar Germany and the South American countries, because that debt can't be monetized or restructured as easily. Printing money/debt monetization and government guarantees are inevitable in depressions in which interest rate cuts won't work, though these tools are of little value in countries that are constrained from printing or don't have assets to back printing up and can't easily negotiate the redistributions of the debt burdens. All of the deleveragings that we have studied, which is most of those that occurred over the past 100 years, eventually led to big waves of money creation, fiscal deficits, and currency devaluations, against gold, commodities, and stocks. In different cases, policymakers have varied which exact combination of the levers they used, typically as a function of the nature of their monetary systems. The chart below conveys the archetypal path of money printing in deflationary deleveragings over the 21 cases. The money printing occurs in two classic waves. Central banks first provide liquidity to stressed institutions, and then they conduct large-scale asset purchases to broadly stimulate the economy. 6%, 8%, 10%, 12%, 14%, 16%, 0%, 1%, 2%, 3%, 4%, 5%, 6%, -60, -48, -36, -24, -12, 0, 12, 24, 36, 48, 60, 72, 84. Initial liquidity injection. Large-scale asset purchases begin. Nominal short-rate money, %PGDP, early part of the cycle, 1. Bubble, 2. Top, 3. Depression, 4. Beautiful deleveraging, 5. Pushing on a string/normalization, 6/7. 654,321. Below we show the average real exchange rate versus trade partners, which reflects the strength/weakness of a currency relative to the country's trade partners. 654,321 -6%, -4%, -2%, 0%, 2%, 4%, 6%, 8%, -60, -48, -36, -24, -12, 0, 12, 24, 36, 48, 60, 72, 84. Real FX vs CHUI. Early part of the cycle, 1. Bubble, 2. Top, 3. Depression, 4. Beautiful deleveraging, 5. Pushing on a string/normalization, 6/7. Part 1. The archetypal big debt cycle. 34. Typically, governments with gold commodity or foreign currency pegged money systems are forced to have tighter monetary policies to protect the value of their currency than governments with fiat monetary systems. But eventually the debt contractions become so painful that they relent, break the link, and print, i.e., either they abandon these systems or change the amount/pricing of the commodity that they will exchange for a unit of money. For example, when the value of the dollar, and therefore the amount of money, was tied to gold during the Great Depression, suspending the promise to convert dollars into gold so that the currency could be devalued and more money created was key to creating the bottoms in the stock and commodity markets and the economy. Printing money, making asset purchases, and providing guarantees were much easier to do in the 2008 financial crisis, as they didn't require a legalized and official change in the currency regime. The chart below shows the archetypal path of gold prices. In the U.S. Great Depression, gold rose overnight when Roosevelt broke the gold peg, and during the more recent financial crisis, Fed moves helped push down the value of the dollar versus all currencies, including gold. 654,321 25 50 75 100 125 150 175 200 -60 -48 -36 -24 -12 0 12 24 36 48 60 72 84 Early part of the cycle. 1. Bubble. 2. Top. 3. Depression. 4. Beautiful deleveraging. 5. Pushing on a string/normalization. 6/7. Gold price, local FX, indexed. In the end, policymakers always print. That is because austerity causes more pain than benefit. Big restructurings wipe out too much wealth too fast, and transfers of wealth from haves to have-nots don't happen in sufficient size without revolutions. Also, printing money is not inflationary if the size and character of the money creation offsets the size and character of the credit contraction. It is simply negating deflation. In virtually all past deleveragings, policymakers had to discover this for themselves after they first tried other paths without satisfactory results. History has shown that those who did it quickly and well, like the US in 2008-09, have derived much better results than those who did it late, like the US in 1930-33. The table below summarizes the typical amount of printing and currency devaluation required to create the turn from a depression to a beautiful deleveraging. On average, the printing of money has been around 4% of GDP per year. There is a large initial currency devaluation of around 50% against gold, and deficits widen to about 6% of GDP. On average, this aggressive stimulation comes 2 to 3 years into the depression, after stocks have fallen more than 50%, economic activity has fallen about 10%, and unemployment has risen to around 10 to 15%, though there is a lot of variation. I'm providing these numbers only as broad indicators, since circumstances vary considerably. When looking at the differences, which are very interesting but beyond the scope of this study, it is clear that when monetary and fiscal policies are rolled out faster and smarter, the results are much better than these averages. Policy responses average range 1 length of contraction, months, 55.22 to 79.2 size of FX decline versus gold -44%, -58% to -37%, 3 peak money creation, percent GDP, and 4%, 1% to 9%, 4 peak fiscal deficit -6%, -14% to -1%. Principles for navigating big debt crises. 35. To reiterate, the key to having a beautiful deleveraging lies in balancing the inflationary forces against the deflationary ones. That's because too much money printing can also produce an ugly inflationary deleveraging, which we will go through later. The right amounts of stimulus are those that A. neutralize what would otherwise be a deflationary credit market collapse, and B. get the nominal growth rate above the nominal interest rate by enough to relieve the debt burdens, but not by so much that it leads to a run on debt assets. In summary, when all is said and done, only a few things distinguish whether a deleveraging is managed well or poorly. I have outlined them below. A lot of pain can be avoided if policymakers can learn from the common pitfalls and understand the policy's characteristic of beautiful deleveragings. Well-managed, poorly managed bubble. Central banks consider growth in debt and its effects on asset markets in managing policy. If they can prevent the bubble, they can prevent the bust. Central banks use macroprudential policies to target restraints in debt growth where bubbles are emerging and allow debt growth where it is not excessive. Fiscal policies are tightened. Big bubbles are fueled by speculators and lenders over-extrapolating past successes and making further debt-financed investments, and by central banks focusing just on inflation and/or growth and not considering debt bubbles in investment assets, thus keeping credit cheap for too long. Top central banks constrict the bubble either with the control of broad monetary policy or with well-chosen macroprudential policies, and then ease selectively, via macroprudential policies. Central banks continue to tighten well after bursting the bubble. Depression. Central banks provide ample liquidity, ease short rates quickly until they hit 0%, and then pursue aggressive monetizations, using aggressive targeted macroprudential policies. Governments pursue aggressive and sustained fiscal stimulus, easing past the turn. Systemically important institutions are protected. Central banks are slower to cut rates, provide more limited liquidity, and tighten too early. They also wait too long to pursue aggressive monetization. Governments pursue austerity without adequately easing. Systemically important institutions are left damaged or failed. Beautiful deleveraging reflations begin with aggressive monetizations through asset purchases or big currency declines, enough to bring nominal growth above nominal rates. Stimulative macroprudential policies are targeted to protect systemically important entities and to stimulate high-quality credit growth. Non-systemically important institutions are allowed to fail in an orderly way. Policymakers balance the depressive forces of defaults and austerity with the reflationary forces of debt monetization, currency declines, and fiscal stimulus. Initial monetization stutter and start. Asset purchases are more muted and consist more of cash-like instruments rather than risky assets, so that purchases don't produce a wealth effect. Stimulation of the central bank is undermined by fiscal austerity. Over-indebted entities are protected even though they are not systemically important, leading to zombie banks and malaise. Ugly inflationary depressions arise in cases where policymakers allow faith in the currency to collapse and print too much money. 6. Pushing on a string late in the long-term debt cycle. Central bankers sometimes struggle to convert their stimulative policies into increased spending because the effects of lowering interest rates and central banks' purchases of debt assets have diminished. At such times the economy enters a period of low growth and low returns on assets, and central bankers have to move to other forms of monetary stimulation in which money and credit go more directly to support spenders. When policymakers faced these conditions in the 1930s, they coined the phrase pushing on a string. One of the biggest risks at this stage is that if there is too much printing of money/monetization and too severe a currency devaluation relative to the amounts of the deflationary alternatives, an ugly inflationary deleveraging can occur. To help understand the different kinds of monetary policies that can be used throughout a deleveraging, I think of them as coming in 3 different styles, each with its own effects on the economy and markets. Part 1. The Archetypal Big Debt Cycle. 36 Monetary Policy. 1 Interest Rate-Driven Monetary Policy, which I'll call Monetary Policy 1, is the most effective because it has the broadest impact on the economy. When central banks reduce interest rates, they stimulate the economy by producing a positive wealth effect, because the lower interest rate raises the present value of most investments, b. making it easier to buy items on credit, because the monthly payments decline, raising demand especially for interest rate sensitive items like durable goods and housing, and c. reducing debt service burdens, which improves cash flows and spending. MP1 is typically the first approach to a debt crisis, but when short-term interest rates hit around 0%, it no longer works effectively, so central banks must go to the second type. Monetary Policy 2. Quantitative easing, QE, as it is now called, i.e., printing money and buying financial assets, typically debt assets, is Monetary Policy 2. It works by affecting the behavior of investors/savers as opposed to borrowers/spenders, because it is driven by purchases of financial assets, typically debt assets that impact investors/savers the most. When the central bank buys a bond, it gives investors/savers cash, which they typically use to buy another financial asset that they think is more attractive. What they do with that money and credit makes all the difference in the world. When they invest in the sort of assets that finance spending, that stimulates the economy. When they invest in those that don't, such as financial assets, there must be very large market gains before any money trickles down into spending, and that spending comes more from those who have enjoyed the market gains than from those who haven't. In other words, QE certainly benefits investors/savers, i.e., those who own financial assets, much more than people who don't, thus widening the wealth gap. While MP2 is generally less effective than interest rate changes, it is most effective when risk and liquidity premiums are large, because it causes those premiums to fall. When risk premiums are large, and money is added to the system, actual risks are reduced at the same time that there is more money seeking returns, which triggers purchases of riskier assets that are offering higher expected returns, driving their prices up and producing a positive wealth effect. But over time, the use of QE to stimulate the economy declines in effectiveness because risk premiums are pushed down and asset prices are pushed up to levels beyond which they are difficult to push further, and the wealth effect diminishes. In other words, at higher prices and lower expected returns, the compensation for taking risk becomes too small to get investors to bid prices up, which would drive prospective returns down further. In fact, the reward-to-risk ratio could make those who are long a lot of assets view that terribly returning asset called cash as more appealing. As a result, QE becomes less and less effective. If they provide QE and private credit growth doesn't pick up, policymakers feel like they are pushing on a string. At this stage, policymakers sometimes monetize debt in even larger quantities in an attempt to compensate for its declining effectiveness. While this can help for a bit, there is a real risk that prolonged monetization will lead people to question the currency's suitability as a storehold of value. This can lead them to start moving to alternative currencies, such as gold. The fundamental economic challenge most economies have in this phase is that the claims on purchasing power are greater than the abilities to meet them. Think of it this way: there are only goods and services. Financial assets are claims on them. In other words, holders of investments/assets, i.e., capitalists/investors, believe that they can convert their holdings into purchasing power to get goods and services. At the same time, workers expect to be able to exchange a unit's worth of their contribution to the production of goods and services into buying power for goods and services. But since debt/money/currency have no intrinsic value, the claims on them are greater than the value of what they are supposed to be able to buy, so they have to be devalued or restructured. In other words, when there are too many debt liabilities/assets, they either have to be reduced via debt restructurings or monetized. Policymakers tend to use monetization at this stage primarily because it is stimulative rather than contractionary. But monetization simply swaps one IOU, debt, for another, newly printed money. The situation is analogous to a Ponzi scheme. Since there aren't enough goods and services likely to be produced to back up all the EIS, there's a worry that people may not be willing to work in return for EIS forever. Principles for navigating big debt crises. 37 Low interest rates together with low premiums on risky assets pose a structural challenge for monetary policy. With monetary policy 1, interest rates, and monetary policy 2, QE, at their limits, the central bank has very little ability to provide stimulus through these two channels, i.e., monetary policy has little gas in the tank. This typically happens in the later years of the long-term debt cycle, example 1937–38, and now in the US, which can lead to pushing on a string. When this happens, policymakers need to look beyond QE to the new forms of monetary and fiscal policy characterized by Monetary Policy 3. Monetary Policy 3 Monetary Policy 3 puts money more directly into the hands of spenders instead of investors/savers and incentivizes them to spend it. Because wealthy people have fewer incentives to spend the incremental money and credit they get than less wealthy people, when the wealth gap is large and the economy is weak, directing spending opportunities at less wealthy people is more productive. Logic and history show us that there is a continuum of actions to stimulate spending that have varying degrees of control to them. At one end are coordinated fiscal and monetary actions, in which fiscal policymakers provide stimulus directly through government spending or indirectly by providing incentives for non-government entities to spend. At the other end, the central bank can provide helicopter money by sending cash directly to citizens without coordination with fiscal policymakers. Typically, though not always, there is a coordination of monetary policy and fiscal policy in a way that creates incentives for people to spend on goods and services. Central banks can also exert influence through macroprudential policies that help to shape things in ways that are similar to how fiscal policies might. For simplicity, I have organized that continuum and provided references to specific prior cases of each below. An increase in debt-financed fiscal spending. Sometimes this is paired with QE that buys most of the new issuance, example in Japan in the 1930s, US during World War II, US and UK in the 2000s. Increase in debt-financed fiscal spending, where the Treasury isn't on the hook for the debt, because the central bank can print money to cover debt payments, example Germany in the 1930s. The central bank can lend to entities other than the government that will use it for stimulus projects, example lending to development banks in China in 2008. Not bothering to go through issuing debt, and instead giving newly printed money directly to the government to spend. Past cases have included printing fiat currency, example in Imperial China, the American Revolution, the US Civil War, Germany in the 1930s, and the UK during World War I, or debasing hard currency, Ancient Rome, Imperial China, 16th century England. Printing money and doing direct cash transfers to households, i.e., helicopter money. When we refer to helicopter money, we mean directing money into the hands of spenders, example US veterans' bonuses during the Great Depression, Imperial China. How that money is directed could take different forms. The basic variants are either to direct the same amount to everyone or aim for some degree of helping one or more groups over others, example giving money to the poor rather than to the rich. The money can be provided as a one-off or over time, perhaps as a universal basic income. All of these variants can be paired with an incentive to spend it, such as the money disappearing if it's not spent within a year. The money could also be directed to specific investment accounts, like retirement, education, or accounts earmarked for small business investments, targeted towards socially desirable spending/investment. Another potential way to craft the policy is to distribute returns/holdings from QE to households instead of to the government. Big debt write-down accompanied by big money creation, the year of Jubilee, as occurred in ancient Rome, the Great Depression, and Iceland. Part 1. The Archetypal Big Debt Cycle 38. While I won't offer opinions on each of these, I will say that the most effective approaches involve fiscal/monetary coordination, because that ensures that both the providing and the spending of money will occur. If central banks just give people money, helicopter money, that's typically less adequate than giving them that money with incentives to spend it. However, sometimes it is difficult for those who set monetary policy to coordinate with those who set fiscal policy, in which case other approaches are used. Also, keep in mind that sometimes the policies don't fall exactly into these categories, as they have elements of more than one of them. For example, if the government gives a tax break, that's probably not helicopter money, but it depends on how it's financed. The government can also spend money directly without a loan financed by the central bank, that is helicopter money through fiscal channels. While central banks influence the costs and availabilities of credit for the economy as whole, they also have powers to influence the costs and availabilities of credit for targeted parts of the financial system through their regulatory authorities. These policies, which are called macroprudential policies, are especially important when it's desirable to differentiate entities, e.g., when it is desirable to restrict credit to an overly indebted area while simultaneously stimulating the rest of the economy, or when it's desirable to provide credit to some targeted entities but not provide it broadly. Macroprudential policies take numerous forms that are valuable in different ways in all 7 stages of the big debt cycle. Because explaining them here would require too much of a digression, they are explained in some depth in the appendix. 7. Normalization. Eventually the system gets back to normal, though the recovery in economic activity and capital formation tends to be slow, even during a beautiful deleveraging. It typically takes roughly 5 to 10 years, hence the term lost decade, for real economic activity to reach its former peak level. And it typically takes longer, around a decade, for stock prices to reach former highs, because it takes a very long time for investors to become comfortable taking the risk of holding equities again, i.e., equity risk premiums are high. Recovery conditions average range 1 length of equity drawdown, months, 1960 to 249 2 length of GDP drawdown, months, 72.25 to 106 3 change in debt to GDP post-stimulation -54% -70% to -29%. Now that you have this template for deflationary depressions in mind, I encourage you to read the detailed accounts of the US 2007 to 2011 and 1928 to 1937 big debt cycles shown in Part 2, and then look at the summary statistics and auto text of the 21 case studies shown in Part 3. Principles for navigating big debt crises. 39 Inflationary depressions and currency crises. In the previous section, we looked at the archetypal deflationary debt crisis, which we created by averaging the 21 deflationary cycles. You can review in Part 3. We will now look at the archetypal inflationary debt crisis, which we created by averaging the 27 worst cases of inflationary cycles, also shown in Part 3. After reviewing this template, I encourage you to read about the hyperinflation in Germany's Weimar Republic, which is examined in depth in Part 2, to compare it to the archetypal case described here. Before we turn to the charts and other data, please remember that currency and debt serve two purposes: to be 1, mediums of exchange, and 2, storeholds of wealth. Debt is one person's asset and another's liability. Debt is a promise to pay in a certain type of currency, example dollars, euro, yen, pesos, etc. Holders of debt assets expect to convert them into money and then into goods and services down the road, so they are very conscious of the rate of its loss of purchasing power, i.e., inflation, relative to the compensation, i.e., the interest rate, they get for holding it. Central banks can only produce the type of money and credit that they control. Example: the Fed makes dollar-denominated money and credit, the BOJ makes Japanese yen money and credit, etc. Through a symbiotic relationship, over time central banks and free market borrowers and lenders typically create bigger and bigger piles of debt assets and debt liabilities. The bigger the pile, the greater the challenge for central bankers to balance the opposing pressures so the pile doesn't topple over into a deflationary depression in one direction or an inflationary depression in the other. Policymakers, those who control monetary and fiscal policies, can usually balance these opposing forces in debt crises because they have a lot of power to redistribute the burden so they are spread out. Though they can't always balance them well, central banks typically relieve debt crises by printing a lot of the currency in which the debt is denominated, which, while stimulating spending on investment assets and the economy, also cheapens the value of the currency. All else being equal, if a currency falls in relation to another currency at a rate that is greater than the currency's interest rate, the holder of the debt in the weakening currency will lose money. If investors expect that weakness to continue without being compensated with higher interest rates, a dangerous currency dynamic will develop. That last dynamic, i.e., the currency dynamic, is what produces inflationary depressions. Holders of debt denominated in the poorly returning currency are motivated to sell it and move their assets into another currency or a non-currency storehold of wealth like gold. When there is a debt crisis and economic weakness in a country, it is typically impossible for the central bank to raise interest rates enough to compensate for the currency weakness, so the money leaves that country and currency for safer countries. When so much money leaves the country that lending dries up, the central bank is faced with the choice of letting the credit markets tighten or printing money, which produces a lot of it. While it is widely known that central banks manage the trade-offs between inflation and growth by changing interest rates and liquidity in the system, what is not widely known is that the central bank's trade-offs between inflation and growth are easier to manage when money is flowing into a country's currency/debt and more difficult to manage when it's flowing out. That's because if there is more demand for the currency/debt, that will push the currency/debt prices up, which, all else being equal, will push inflation down and growth up. Assuming the central bank keeps the amount of money and credit steady, when there is less demand, the reverse will happen. How much changing demand there is for a country's currency/debt will create changes in the currency versus changes in interest rates will depend on how the central bank moves its levers, which I'll cover below. For now, suffice it to say that in times when money is flowing out of a currency, real interest rates need to rise less if real exchange rates fall more, and vice versa. Part 1. The Archetypal Big Debt Cycle for
はい、こんにちは。元気です。今日はリセットボタンというですね、電子書籍の方を出版させていただきました。はい。で、Amazon と、楽天のコボですね、の方で、買っていただいて読めますので、ぜひこの機会にですね、読んでいただければと思います。はい。で、すべてはマシーンというサブタイトルがついてるんですけども、この言葉はですね、レイダリオさんっていうですね、アンソニー・ロビンズさんの経済だったり、投資家の中のですね、部分のメンターって言われてる方で、この史上最高をですね、稼がせるリーダーとして、ご紹介されてる方なんですけども、ウォーレン・バフェットだったりとか、アマゾンのジョフ・ベゾスだったりとか、ビル・ゲイツだったりとかいると思うんですけど、またちょっとタイプがちょっと若干違いまして、史上最高の稼がせるリーダーっていう部分で、投資家の方の、言葉なんですね。で、これからAI だったりロボットだったりとか、本当にテクノロジーの部分でいろんなものがですね、急速に進んでいくと思うんですけども、その中の変化の中での、考え方だったりとか、未来予測的な部分だったりとか、様々なものをですね、私の方で、書かせていただいている内容になっています。で、この今シリーズ第1作目になりますので、一応もう2作目ができていて、3作目を今書いてるんですけども、ちょっと出版はもうちょっと時間がかかるかと思うんですけども、ぜひですね、この機会にリセットボタンということで検索していただくか、もしくはリンクの方からですね、すぐに読めますので、よかったらぜひこの機会に買ってください。はい、よろしくお願いいたします。ありがとうございました。はい。で、第1回目はですね、リセットがなぜ必要かっていうことだったり、脳のお話だったり、これから AI ロボットだったりとか、そういった部分のお話になってました。で、第2巻、今回もですね、今すぐリセットが必要な方だったりとか、今後どうなっていくのかっていうことも含めてですね、書いてあります。そして私の方のメッセージの方も書いてありますのでですね、ぜひそちらの方も読んでいただきたいなと思います。そしてYouTube の方で約10分間内容の方ですね、読んでいるのがありますので、よかったらそちらの方もご覧いただければなと思います。はい、ぜひよろしくお願いいたします。はい、ありがとうございました。Thank you. シェシェイ。